Hello guys, welcome to Khoa Academy, and in this video we'll be talking about a very important yet confusing topic in taxation, and that is double taxation. We'll talk about the concept, we'll talk about the examples, and then we will discuss the ways in which double taxation can be avoided. So watch till end and you will learn a lot of things about double taxation. So what is double taxation? Double taxation is when the same income is taxed twice. For example, if there is $100 of income in the hand of one taxpayer, and that taxpayer has paid tax on this income, and when it passes on to another taxpayer, then that same $100 is taxed to that taxpayer also. So essentially, same dollar is taxed twice. Examples are now double taxation occurs in two ways. One is economic double taxation, and second is jurisdictional double taxation. Now, in economic double taxation, $1 of income is taxed twice. For example, talk about corporate dividends. Now, companies, when they earn a profit, they pay corporate tax, and rates vary from countries to countries, but they do pay taxes on their profits. Now, when those profits are distributed to shareholders in the form of dividends, that dividend income is also taxed in the hands of the shareholders. So, effectively, same income is taxed twice, one in the hands of the company and second in the hands of the shareholders when they receive the dividends. Now, some people say that it's not unfair because company is a separate legal entity, and when the company earns the income, it has a duty to pay the taxes, and shareholders are different from a company. They are a separate entity. So when shareholders earn an income in the form of dividends, they have to pay the taxes on that income. But some people believe that no, it's unfair, that let's suppose shareholders contributed $100 to the company, and if the company is earning profit, then of course it's because of the money which shareholders contributed. So once the shareholders which contributed money to the company, their money is taxed in the company in the form of corporate taxes, then it's unfair that once they receive the profit, it should also be taxed when they receive dividends. So it's unfair, they say. How do companies try to avoid this form of double taxation? Well, what they try to do is that they do not pay the dividends to the shareholders, or at least they try to delay it. By this way, dividends are not taxed, and the company profits are only taxed once. But there is also a caveat to this. For example, when the companies don't pay dividends, what happens is that the share prices of the company increase, and ultimately, when the shareholders sell those shares, they will have to pay capital gains tax. So they can reduce the double taxation, but they cannot solely avoid it. Second type of double taxation is jurisdictional double taxation. This is when, for example, an employee or a resident of India, say, is working in United States. Now, the United States government will deduct tax from him on salary income, whereas in India, he will have to pay taxes because he is a citizen of India. Now, what countries do is that they sign double taxation treaties among themselves. So, if I am an Indian and I work in US, then the Indian government, when I will file the return, annual tax return, they will give me tax credit to the extent of the amount of tax which I paid in the United States. So this way, this jurisdictional double taxation is avoided. I hope your concepts got clear after watching this video, and if you liked the video, do share it, and also don't forget to subscribe the channel. Thank you so much.